Welcome, welcome. We are going to be talking about individual taxation, which I know is an exciting area, and some of you are familiar with this. You've done your own tax returns and so on. Some of you do a 1040 EZ, which unfortunately they're not going to tell. They don't say, please prepare a 5-line 1040 EZ and have a lovely day, become a CPA. No, generally it's much more detailed. This is the first area of tax. We're going to be going through tax first. So we're going to 60%, so we're going to cover individual, corporate, S-corps, partnerships, estates, trust, gift, exempt organizations, property transactions, depreciation, AMT, and all that. Then we'll move on to professional responsibilities and ethics, because those areas alone are about 20%. Then business law used to be, back in my day, its own exam. So it was its own 3.5-hour exam back when I was your age, many moons ago, pre-gray hair. So they have a lot, 3.5 hours of information, which is it's 20% of a 3-hour exam. So you can see that there's a lot of material for law, even though it's only 20%, because they've kind of pared it down. So you need a little bit about a lot, especially when it comes to business law. Now, in starting out with individual taxation, you do not need to memorize things like the tax code, right? The IRC, or Internal Revenue Code, you will use for research, but you don't need to memorize that. You don't need to memorize necessarily cost of living adjusted information, because again, these numbers change every year. For example, bankruptcy, every 3 years they update the numbers. Those we need to know. But numbers like your standard deduction, personal exemptions, you don't need to know those. Why not? Because they change every year. The AICPA cannot afford to update every single question every single year for those numbers. So those are things you don't need to know. You do need to know the schedules. What is Schedule A? Schedule A, itemized deductions. Schedule B, interest and dividends. Schedule C, profit or loss from a trade or business. Schedule D, capital gains and losses. Schedule E, flow through entities, rental, royalty, S-corps, partnership, K1 income flows through. Schedule F, farm income. Those are things you will need to know. You will need to know certain thresholds. For example, medical expenses is 10%. Used to be 7.5%. It's 10%. Unless you're 65 or older, then it's still 7.5%. But you do need to know things like that, medical deductions. You do need to know, for example, 2% miscellaneous deductions. So that's business, investment, tax preparation, and so on. So those are things you will need to know. As we go through the questions, you'll see very important. Now, one of the things that I want to point out is when you're preparing for the exam, taxes are always changing. The thing is, there's at least a 6-month window between laws changing and it hits the exam. That means that, let's say you're taking an exam in the first part of 2014, that's 2013 law. The second half of 14 would be 2014 law. The first part of 2015 would be 14 law. The second part of 15 would be 15 law. So I want you to realize that the first 2 windows of the year are always the previous year's tax rules, and then the second part would be that current year's, because it gave you 6 months for those things to change. But that's why, again, there's that overlap. That's why they're not going to test you on the specific things as far as standard deductions, things that change, but rules like the 10%, that's not going to necessarily change. Those are the numbers that they're going to like to test you on. So that's important before we even jump in, so you understand what's happening. Now, you'll see here, and I love memory aids and mnemonics. I'm Mr. Mnemonic. Woohoo, right? I love these things because they help you, once you understand it, to then be able to recall it. So that's the purpose of it. What we're going to be looking at here is our basic 1040 tax return. And the 1040, we've got our schedules A, B, C, D, and so on. With your tax return, it starts out with your filing status. Filing status means, what are you as of December 31st, right? So if you're sitting at home alone watching TV and watching the ball drop with whatever, Ryan Seacrest or Dick Clark, I think he's died now. But anyway, you watch the ball drop, you're single because you're alone, home alone, and crying. All right, that's single. Married filing joint, married filing separate, head of household. We'll have to learn what all the distinctions are between those categories. Exemptions. What's an exemption? Myself, I'm alive, woohoo, I get a certain amount of money. I'm married filing joint, so I have myself, my personal exemption. My spouse would also be a personal exemption. So the two of us, we would get a certain amount of money, let's just say roughly $4,000. And again, it changes every year, $39,000, $39,500, $4,000, and so on. You don't need to memorize it, but in your notes, you will have the current number just in case you wanted it. So that is it. Then I've got these wonderful little rugrats running around, my kids. So the question is that a qualified child or is it a qualified relative, dependent? we'll have to see, because if you count, then I get another 4,000 for you, 4,000 for you, 4,000 for you. So I get 4,000 for me, 4,000 for my wife, 4,000 for my kid, my other kid, the other kid. What about a cousin who lives with me? I don't know. Let's see. Are they a relative? We'll learn that later on. So I get all those exemptions. I got 5 of them at 4,000. That's another 20 grand. Woohoo! Then I've got income. So we'll go through the detail of the income, but one of the things that I want you to see is the flow of the 1040. And the flow is as follows. You got your 1040. Incidentally, when is your 1040 due? It is due how many months after year end? It's due what? April 15th, which is how many months after year end? And you are allowed to bring your fingers to the exam, right? They don't make you cut them. So January, February, March, April. That's January, February, March, April 15th. That's 4.5 months after year end. March, April, no. What is that, 3.5? January, February, March, no, March 15th, yeah, 3.5. No, 4.5. 4.5 months after year end. January, February, March, all of April, no, half April. 3.5 months. Okay, so that's 415. Now, think about a corporation. Corporations are these big, sophisticated entities. They have an internal accounting department. Therefore, we give you one less month. So corporations, instead of 415, would be 315, which is January, February, half of March, which is 2.5 months after year end. This is 3.5 months after year end. Very good. Then you go to my favorite place where I buy all my clothes and jewelry, the Goodwill. Now, when you go to the Goodwill, you ever notice I go, hey, can I see that? And everybody walks really slowly. Well, these are called tax-exempt organizations. They are tax-exempt, so what does that mean? The government gives them 1 extra month. So they're due not 415, but 515, which is 4.5 months after year end. So you've got 315 for corporations, 415 for individuals, 515 for exempt organizations like 990s. So we'll talk about that, but that's just kind of a nice starting point of what and when it is due. You've got your gross income, that's your worldwide income, all of our income, and we're going to talk about what is income, wages. So I'm an employee, I get a W-2. I'm an independent contractor, I get a 1099, but then I'm responsible for keeping track of my expenses and all that. I've got taxable refunds, so I got a refund. The question is it taxable? Alimony received, capital gains, IRA distributions, pensions, rental, farm, unemployment compensation. So unemployment is income. It's a wage substitute, therefore it's taxable income. That is called unemployment. What about workers' comp? You're injured? No. So we'll talk about that later. Then you've got other income, and that's just a line other income. You could write stuff in there like jury duty fee received. That would go there as well. Then you've got all these other adjustments and expenses. We talk about like if you put money into your IRA, deductible part of self-employment tax, alimony that you pay. So we'll learn that alimony is taxable, and if I'm the one paying it, tax deductible. So all these adjustments are these. And I always, like I said, I love memory aids and mnemonics. This is I embraced education, health, and farm. So I embraced. So that's going to be I-E-M-B-R-A-C-E-D-E-H-F. So that's going to be, and this is what? This flows to the face of your 1040. Now on the bottom line of the 1040, that bottom line number is a really important number. It is called AGI. What is that? Adjusted gross income. A lot of times certain thresholds are based on AGI. They may say, for example, hey, you can only deduct medical expenses above and beyond 10% of AGI. What does that mean? If my AGI is 100 grand, I had a good year, made a lot of money, 100 G's. 100 grand. Guess what? I cannot deduct $1 of medical expenses until I hit 10% of that, or 10 grand. That's why in the real world, unless you have an uninsured catastrophic injury, most of us have insurance, good old Obamacare. The point is that we have this insurance, so what it says is, you know what, it's got to be uninsured over 10 grand. So in reality, you probably won't have any. For the exam, of course, we're going to always have everything, so we'll have to include that. Then you've got your standard deduction. And the government says, oh, you're alive, let's just give you a certain amount, and let's just say it's about, I don't know, $61, $62, $63, $6,400. So let's say it's $6,200, for example. Double that would be $12,400. So if you're married filing joint, we used to have this marriage penalty, which basically said that if you were single, you got, let's say, just make it easy, 6 grand. But if you were married, instead of getting 12, you got like 11. It's like, dude, we're better off filing separate in a sense, or not being married, because then we each get 6. They finally got rid of that penalty. That's why I didn't get married until later in life, because, dude, tax reasons. You know, I love you, but it's just not beneficial. So then they got rid of that. So whatever the single is, let's say 62, married filing joint would be double 12.4. So that is called standard. Or you can itemize. And your itemization is Schedule what? Schedule A. You need to remember that. Schedule A is your itemized deductions. And itemized deductions, and I'll show you later, but we're going to have a memory aid that you'll have to remember. Commit. And you should commit this to memory. Why? Because these are your itemized deductions. In other words, either you take $6,200 the government's given you, or you say, you know what? It's going to be, see, charitable contributions, other miscellaneous 2%, which is business, investment, tax preparation, medical, 10%, interest, taxes, theft, and casualty. So if I could itemize, or I could take the standard, it's one or the other. So you don't get both, you get one or the other. Then you have your net exemptions. Remember I talked about an exemption. We'll learn a mnemonic or memory aid for exemptions. See the IRS jack you out of your money, which means, can I take my cousin off as a dependency exemption and get whatever, let's say get $4 grand for them. You can if they're a citizen, they don't make much income, they're related to you or live with you the entire year, you support them, and they're not filing a joint tax return. See the IRS jack you out of your money. There's another mnemonic. So that's how we know if someone is a net exemption. So I get some money there. Taxable income times the tax rate. You don't need to memorize it. Let's say it's 39.6, 40%. Boom, tax liability. Then you've got your credits. A credit is a dollar for dollar reduction. So I have some sort of credit. Maybe it's educational credit or a child tax credit or an elderly credit. Some kind of credit, right? Earned income credit. Then I've got self-employment tax. So I might have self-employment tax here we'll talk about. So I'm self-employed and I need to pay that tax, which is, let's say, 15.3%. Then you've got AMT. Ooh, what's AMT? Alternative minimum tax. And alternative minimum tax was created in order to squeeze a little extra money out of everybody's pocket. Because what it said is, let's calculate your tax this way, then we'll calculate an alternative way, and whichever one is higher, that's what you owe. So let's say, for example, your regular tax is higher, they go, cool, you're paying us enough. Let's say your AMT is higher, they go, okay, you're going to pay us this. The difference is your alternative minimum tax. It's like a penalty tax. So all of these down here, this is going to be kind of a penalty tax. So the penalty is, hey, dude, you made too much money. We're going to disallow certain itemized deductions. So what happens is some of these things in commit, they start to take away. So they say, well, you took too much for this, we're going to take it away. You know these exemptions, it's not a real out-of-pocket outlay, we're going to take it away. So they're going to take stuff away, that's AMT. Then you've got prepayments, because let's say, for example, I'm retired and I have $100,000 in the bank. Let's just pretend that interest rates, I could earn 10%, which I used to be able to earn. Now I'm getting, less than 1. So let's say I was earning 10%. So I have $10,000 of income. No one's withholding taxes on that. So I'm going to have to prepay. I'm going to have to do some kind of estimated taxes, a 1040 ES, estimated tax. Withholdings would be like your W-4, which is when you get a new job and you're an employee, you fill out the form and it says how many dependents you have and this and that and other things you think about your mortgage interest deductions. You're trying to come up with an amount where your withholdings are enough, so at the end of the year the goal is to have no refund. Like a lot of people go, wow, I got a great big refund, that's great. That ain't so great. You let the government borrow your money interest-free all year. Where if you would have taken that money, invested it wisely, you could have earned a bunch of money on it, and then at the end, you pay that. So a lot of people, what they do is they go, you know, I just hope for a refund because then the government's saving my money for me. Yeah, but you're giving it to them, like I said, an interest-free loan. So that's withholdings, and then there's your tax due. So this is the basic flow of your 1040. That is a 1040 called your individual tax return, called a 1040. Again, it's due when? 4/15, which I had trouble earlier, is how many months after year end? January, February, March, 3.5 months after year end. Thank you very much. So you'll see just in starting, we've got some mnemonics. Commit. See the IRS. Most importantly, I embraced education, health, and farm. So we'll be going through this, but notice this goes here. Now, very important terms. This gets you to AGI. This is called for or to AGI. These are taken away. These are called from AGI. So they've asked questions about, is it for AGI or from? For means it gets you for or to adjusted gross income. From says, let's take our bottom line number on the face of our 1040 called AGI. Then on the back side, you start with AGI, and then these are all the things from AGI. So all of these are on the back side, like what? Itemized or standard deduction, exemptions, AMT, alternative minimum tax. Here are all the different credits and so on. So that's going to be from AGI. 4 gets you to, so this is part of 4. I embraced is part of 4 AGI, whereas the other side is from AGI, and that would be on the back side of it. So it's important again to kind of understand the flow so you can see how all of this is kind of interrelated. You'll see on the first page that we included here the basics so you can understand the flow. Again, you'll see gross income, adjustments, and that's where your schedules flow in. So when we talk about all your different tax schedules, we're going to talk about Schedule B, C, D, E, F. They all flow through here to the face of your 1040 4 or 2 AGI. On the back side is Schedule A from AGI. So A is a from AGI, whereas I embraced education, health, and farmers goes on the face, that's 4. So when we go through this, you'll see in detail student loan interest, self-employment tax, moving expenses, business expense, Schedule C, rental royalty flow through, Schedule E, alimony paid, contributions to your retirement, 401k. You've got early withdrawal penalty, jury duty fees, education. Here's your farm income. So notice we've got schedules. B is interest and dividends, C, boom, D is capital gains, E, flow-through entities, F, farm, all of those are here. They flow through to the face of your 1040. So that's a nice, easy way to remember it, whereas, boom, on the back side is Schedule A. Those are coming from AGI as a reduction of your adjusted gross income. You'll see there on the right, for AGI, and then it says there, I embraced education, health, and farmers. I put there itemized or your standard deduction. So the number you'll see there is the current amount for your year. Not that you need to know it, but that's the number, just so you have an idea. Whether it's 62 or 63 or 6,400 times 2 would be married filing joint. Net exemptions, let's say about $4,000 plus. Then you've got your 4 AGI from AGI. You'll see here your kind of penalty taxes in a sense, your self-employment, AMT, withholdings, prepayments, and so on. Going back to Schedule A, the other box is your Schedule A commit. Those are things you want to commit to memory. Now, if you turn to the back of this, I have the lecture notes. Behind that, I have the tax forms. With the tax forms, again, the tax forms, you do not need to memorize them. They don't usually change a lot from year to year. As far as the printing of your book, whatever the most recent tax forms available, those are in your notes. If you want to see more recent ones, go to irs.gov. irs.gov, and you can look it up. But from one year, the 2014 to 2015 1040 doesn't change that much. The concepts, again, they're testing on the general broad concepts. But if you look in the back of the lecture notes, about page 30, 32, somewhere around there, 34, starts your tax forms. And the tax forms are as follows. Here's your 1040, the face of the 1040, and we're going to talk about a lot of this stuff coming up in the next few minutes. Then on the back side of the 1040, here's your from AGI. Then you get down to here, you've got your payments, other taxes like self-employment tax, Schedule SE, self-employment, and then all the way down. And then you've got amount you owe or amount you're getting refunded. Here is your Schedule A. Schedule A, the mnemonic or memory aid is going to be Schedule A, commit. So you can write that at the top of the page, COMMITT. And you'll see as you go down, you're going to have here it has medical expenses, going to be 10%, taxes you paid, interest, charity, casualty, miscellaneous expenses, other miscellaneous. So we'll have to distinguish between the two categories of miscellaneous, because some miscellaneous, you get them all. Some of them, only those above 2% of adjusted gross income. You've got your Schedule B, interest and dividends. You need to fill that out if you've got more than about $1,500 of interest and or dividends. And again, the government just wants to know where, they're concerned, do you have overseas accounts that you're not telling us about? Because as you'll see, you get a foreign tax credit for taxes you pay in another country, but all your worldwide income is taxable. We want it all, right? The government needs your money, right? They dig a hole. We talked about that in BEC for economics. It's called deficit spending. Hey, we don't have the money, let's spend it anyway. What the heck? Schedule C is a profit or loss, and this is basically like an unincorporated little business, like a little corporation, but it's unincorporated. That's your profit or loss. That's if you get a 1099, that would go on your Schedule C. So with a Schedule C, you'll see here, you've got your income, then you've got all your different expenses, and just like as I teach you corporate tax, which is I think the next section, we'll talk about a C Corp. So you'll see advertising, car, truck expense, depreciation, depletion, insurance, mortgage, legal, office, vehicles, meals and entertainment, travel. Can you deduct that for a business? Yes. If you're an unincorporated business, Schedule C, we'll put it here. But then at the end, nobody's withholding FICA, Federal Insurance Contribution Act, Social Security, 6.2%. Nobody's withholding Medicare, 1.45. Unless you're rich, it goes up by 0.9%. So all of these are things that say, hey, because no one's withholding, you've got to withhold both, which is like the employer-employee. You owe 15.3%. So if you made $10,000 and you were, you made less than your standard deduction, personal exemptions combined, and so on, so you don't really owe anything, you're still going to owe 15.3% of that 10 grand. You still owe $1,500 of your net employment income, self-employment. So you need to come up with expenses to get the net down, so that way you'll pay them less, because that's self-employment. So that would go right there on Schedule C as well. The back side of it, capital gains, that's going to be short-term, long-term capital gains. What are the capital gain rates? If you're very poor, 0%. If you're up to 35%, 15%. If you're richy rich, 39.6, it's up to 20% capital gains tax. So we'll talk about that when we hit that area. Then we've got Schedule E, supplementary income. Supplementary income is your flow through. That would be Schedule E, things like rental income, royalty income. Flow through entities would be like if you get a K1 from an S Corp or a partnership. Where do you put it? On your Schedule E, which flows through to where? To your 1040. So it's a flow through. It doesn't file its own tax return. It does for information purposes, but as far as paying the dinero, woohoo, that comes here on your Schedule E. So you'll see here it says, Schedule E, boom, 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 rental income, royalty income. Then it has all your expenses, advertising, insurance, commissions, management fees, depreciation, all of that, and we'll talk about that. We'll also talk about passive activity, losses, and so forth. Then you've got, here on the back side, it talks about income or loss from a partnership or S Corp. Here it talks about estates and trusts, because with an estate and trust, they will also issue a K1. Profit or loss from farming, so that's farm. Talk about the cash method or the accrual method. So you've got your different methods that we could be using, cash versus accrual. And then it talks about your expenses as well. Then you've got your self-employment tax, your Schedule SE. That's where you're calculating your 15.3% that we will owe them. So those are the basic tax forms. You don't need to memorize them. Again, you can usually see these, look these up, and so on, but you do need to understand the tax forms and how the tax forms flow. So that's really important as far as getting through. So that's your overview of where we're going with individual tax. In a minute, we'll jump into the details about who has to file a return. How much do you need to make in order to file a return? What are different things like kiddie tax? What's included as income? What's not income? Where does it go? And how are we doing? All right? But we'll do that in just a minute.